Real estate is one of the most foolproof, time-tested methods of securing a lucrative, steady investment. As over the past 38 years, the U.S. home price index has grown at an annualized rate of 4.4%. With the current rental yield at 6.5%, one's forecasted return on investment on U.S. real estate is a strong 10.9% a year. For most people, the idea of owning a rental property or flipping a house may seem out of reach. In this video, I'll detail every way that one can invest in real estate as well as the pros and cons of each method, all for under $1,000. To begin with, we have the most basic method of investing in real estate, which is investing in REITs, or real estate investment trusts. Although the name includes the term trust, in reality, REITs are companies that buy, hold, and sell real estate. However, unlike most publicly owned companies, REITs legally must adhere to certain operational regulations, including distributing at least 90% of their taxable income to shareholders as dividends. These companies are usually giant corporations with multiple investments spread across the entire country, or even the entire world, providing a secure investment with countless redundancies. This also means that these investments come with great liquidity, being able to be bought and sold whenever, at whatever price, without contractual commitments. While many of these companies are quite diversified, most of these publicly listed REITs focus on investing in specific subsectors, exposing themselves to other industries such as the cell tower industry with companies like American Tower and SBA Communications, as well as the data center industry with companies such as Prologis and Equinix. Besides the cell tower and data center industries, you'll find other REITs specializing in entertainment with VICI properties, storage with public storage, and much more. Consequently, besides being giant organizations, REITs provide the opportunity to invest in other industries while still being anchored by the real estate industry. However, given that REITs are indeed corporations and not traditional trusts, their share prices can be quite volatile, with much speculation already factored into the price of each share. This means that the value of these companies likely wouldn't directly reflect the growth of the real estate market and rental yield. Additionally, because they are companies, one can expect an undetermined amount of the profit of REITs to be redirected to employee compensation and other operational costs, presenting a major downside to investing in REITs. Here's an image of a cat. Like and subscribe. The buttons make cool animations. Next up, we have mutual funds and ETFs, or exchange-traded funds. These differ slightly in their organization and liquidity, but nonetheless offer a similar product. Mutual funds and ETFs, as their name suggests, are funds, which use investor capital to buy large quantities of securities and return profit back to their investors. They usually have a predetermined annual management fee to pay for the administration of the fund and operational costs of physically acquiring, selling, and leasing the fund's assets. In this way, investors are able to invest into a large, diversified portfolio directly backed by the value of physical assets, even without much capital. It is important to note that many ETFs, and certainly some mutual funds, invest in pre-existing REITs, and consequently are not as directly backed by physical assets as they otherwise would be. So for investors looking for a direct investment into real estate with a transparent management fee, they should find specific funds that directly acquire and administer real estate. This is where the difference between ETFs and mutual funds becomes clear, as mutual funds more so tend to be comprised of physical assets, whereas ETFs often simply comprised of a broad index of pre-existing companies. Additionally, mutual funds often have active managers who speculate on developments and manage the fund accordingly, much like private hedge funds, although they might also come with larger management fees. Besides the organization difference between mutual funds and exchange-traded funds, while the barrier to entry for ETFs is quite low, mutual funds often, though not always, require larger commitments of capital to invest in, and often have holding periods in which one must, as the name suggests, hold the investment before selling, lest the investor wish to pay a fee or break the contract. Additionally, while ETFs can be bought and sold whenever, at whatever price, investments in mutual funds can only be liquefied at the end of the trading day at 4 p.m. Eastern when the investment's NAV, or net asset value, for the day is calculated. Unlike ETFs, exiting a position in a mutual fund involves being physically cashed out by the fund itself, at an amount determined by the intrinsic value of the entire fund. While this may seem like a negative for mutual funds, the inability for mutual funds to be bought and sold at market prices ensures that the value of the fund itself directly reflects the intrinsic value of the fund's assets, providing a direct investment into real estate. Personally, I think that mutual funds are clearly the way to go compared to ETFs, given the value of investment directly correlates with the real estate market, with the only caveat being a likely larger management fee. As a notable mention, we have collective investing or group investing, where people pool money together to buy individual assets. As it relates to real estate investing for under $1,000, there are a few real estate investing apps, such as Arrived, which provides both accredited and non-accredited investors the option to buy and sell shares of individual properties, allowing investors the opportunity to focus on specific cases when investing in real estate. For reference, accredited investors refers to individuals whose net worth exceeds $1 million, have annual income exceeding $200,000 for the past 2 years with a reasonable expectation of continued earning, or a number of other criteria for either individuals or legal entities that supposedly show the US government that they can invest and not end up homeless after. Of course, such individual investments come with their own management and other fees. Many new real estate investing apps also offer their own diversified funds, as well as individual property investment opportunities for accredited investors only. Among REITs, mutual funds, exchange-traded funds, and collective investing, I'd personally choose mutual funds for investing long-term in real estate, as they provide the unique opportunity to be directly invested in real estate without any speculation worked into the market price. One more thing to note is that most national and international mutual funds simply invest in REITs, so it may be better to research city or state-specific funds to get directly exposed to physical assets without having profits siphoned to companies at an unknown rate if the mutual fund holds a portion of the company. Subscribe to get notified of videos like this in the future. If you have any video suggestions, comment below. Also, click like for a cool animation.